Hi. There's a saying on Wall Street that they never ring a bell at the top. Well, it's not true. You just have to listen to it. For example, they just rang a bell for bonds. Just like last year, they rang it for oil. Remember oil prices? Last year, they went negative when over-bullish futures speculators facing delivery of oil had no place to store it. So they had to pay $40 a barrel to sell the contracts. Paid not to buy, but to sell. That was a clear bell. As I said then, negative oil price was a surefire sign of a bottom in oil. And it sure was. Since then, oil price rose from minus $40 a barrel to plus 65 today. Not surprisingly, some oil stocks tripled. I hope you had bought some. Well, that was last year. But just last month, the same bell rang for bonds. What was the bell? Overnight interest rates for interbank loans went negative. And just as negative oil prices were a sign of a rise in oil price, so negative overnight bank rates, in my opinion, are a sign of a coming big rise in interest rates. And for a similar reason. A year ago, there was too much oil looking for storage. Now it was too much cash looking for storage, a bank to store it in. But why should it matter to you? In a word, your mortgage. If you have a mortgage with a floating rate, you're probably paying 2 or 3% interest. But if the bell on interest rates had indeed been rung, then in less than 5 years, in my opinion, rates could jump to 10%, maybe more, as inflation roars when investors refuse to buy the bonds the Fed desperately wants to sell. Just like in 1980s, Jimmy Carter's economy, with the old among you remember. And if and when this takes place, your floating rate mortgage payments could quadruple and quintuple. Yep, up 4 to 5 times more than you pay now. Ouch! What to do? Consider fixing your mortgage rate today and extend the repayment period to 15 or 20 years, if you can. The longer, the better. Even if your current monthly payment would rise a bit now, see it as an investment. Why investment? Because if floating mortgage payments would go up a lot, your fixed low mortgage payments would be an asset and you could sell it alongside your home. So make sure it's transferable. Now, why would this dark scenario of rising rates happen? Because of a coming high inflation and high unemployment, also known as stagflation, really an economic brownout. Yes, brownout, like in electricity. Let me explain. Remember how a few years back there was a massive electric power failure in North America, also known as a brownout? It happened because a tree branch fell on the generator of an electric utility in Michigan. The utility's computer saw electric generation plunge below demand, so it sent automatically an order to a Vermont utility to ship over some megawatt, as per mutual agreement, also known as electricity swaps. Most North American electric utilities are connected to each other in such swap arrangements. That's because none has enough physical capacity to fulfill peak daylight demand. On the other hand, at night, they often have excess capacity which they can sell to other utilities in other time zones. These mutual swap agreements are contracts, that is, paper obligations, unlike generating capacity, which is physical. So it is far cheaper to write swap deals with other utilities than to build more physical capacity yourself. Texas, by the way, is right now in a similar situation, following a severe storm last month. So now many Texans are faced with electricity bills 4 and 5 times larger than last year. Big ouch. Now, what does this have to do with the bond market and your mortgage payments? Well, as you probably guessed, electricity swaps are directly equivalent to financial swaps that banks have with each other. Some banks have more equity capacity than they need to fulfill the regulatory rules, also known as Basel I and Basel II, while other banks have far too little. And just as electric utilities find it cheaper to write a new swap than to buy another generator, so do banks find it easier and cheaper to rent another bank's excess equity capacity on paper than to build up more equity of their own, which takes real money. So here's the key question, first about utilities, then about banks. Assume you take the sum total of all electricity swaps and compare this to the sum of all physical generation capacity in the electric system as a whole. What do you think will happen if the sum of paper obligations of electric utilities to deliver megawatts on demand to each other is larger than their total physical capacity to deliver? A brownout waiting to happen. That's what. And that is exactly what happened in Michigan a few years back. The Michigan utility's computer sent a demand to the Vermont utility, which couldn't fulfill it. So it passed the demand to the New York utility, which couldn't fulfill it either. And so the demand went around the system, and on the second go-around, the electric system of a third of the US shut down. Was the tree branch to blame? No. The tree branch was just an accidental catalyst. The real problem was the entire sum of electric generation swaps. The system sum of paper obligations became larger than the system's physical capacity to deliver. So a brownout, a crash, was just a matter of time. Which leads us to the global economy and why, in my opinion, an economic brownout is inevitable, which is also the connection to your floating rate mortgage. Just like electricity brownout caused a steep rise in electricity bills, look at Texas last month, so would an economic brownout cause a rise in the price of money, interest rates, a big rise. But you may ask, is the financial system as overburdened as electricity generation was? Is it ever? The total world GDP, gross domestic product, is about $120 trillion, give or take. That's the entire revenues of the global economy available to generate profits, also known as surpluses, to pay interest demands on the debt, which, like demand for electricity, cannot be stopped. So, how much is this total global debt? The visible debt is close to $200 trillion, give or take. And the interest on this debt is becoming unpayable, especially when rates rise, as they are now. But as you probably realize, this is not a real problem. These visible global debts are only equivalent to utilities' bank debts on the balance sheet. The real problem is the invisible debt, the financial swaps and derivatives in the world's financial system that tie all banks together. And how much are these? By various estimates, these could be an additional 500 trillion and perhaps even more than 1,000 trillions, a quadrillion dollars of invisible swaps, also known as derivatives, which means that sooner or later, a metaphorical tree branch will fall on a bank somewhere, and this will trigger a circle of demands via the International Banking Settlement System, also known as SWIFT. And just like the Michigan utility that asked the Vermont utility to come through on its paper promise to send over some megawatt, the broken bank on which the demand will be made won't be able to come through. And so it, in turn, will demand one of its own counterparties to come up with money, which the other bank won't be able to deliver either, because at that point, the entire physical equity in the world banking system would not be enough to support the invisible mountain of derivative sitting on it. Of course, at this point, the worldwide central banks will rush to print even more money, as they do now, trillions of it. But by that time, the need for money to pay ever higher floating rates will rise even faster than the speed of printing. So interest rates will zoom faster and faster and faster. And then, just like an electricity brownout, the economy's brownout would begin. An economic shutdown, worse than COVID, which is where your mortgage rates come in. Because by that time, you'd better have already locked your mortgage at today's low rates, ridiculously low rate, for as long as possible. If not, you may be faced with monthly payments 3 to 4, maybe 5 times as high, perhaps more, like Texans are today paying for electricity. That's why, in my opinion, fixing your mortgage rate could be one of your best investments you could make today. How close are we to economic brownout due to interest rate rise? No one knows, of course. But in my opinion, negative interbank rates was a ringing bell that, like negative oil price a year ago, signaled the beginning of a relentless rise of interest rates. You better be ready. Consider fixing your rates on your mortgage and extending its maturity. It may pay you big time in a few years. That's all for today. Let me know in the comment below what you think of all the above. Subscribe to the channel. Email this video to your friends so they subscribe too. I'll see you next time, and meantime, thank you very much for watching.